Now, despite the weakness in the financials this morning, stocks are set to close out their fourth straight quarter of gains. So joining us now with his take on where the market is headed is Hank Smith. He's Chief Investment Officer at Haverford Investments, which has more than $6 billion in assets. And Hank joins us from Philadelphia. Welcome to the program, Hank. Thanks so much for coming in.
Good afternoon, Scarlet.
Okay, so the Dow's approaching 11,000, the S&P 500 holding near an 18-month high. Do the fundamentals justify the gains we've seen so far?
Oh, we think so, both the fundamentals and the psychology. But first, the fundamentals. You have corporate balance sheets that are in excellent shape. You have profits that are profit growth that is still accelerating, and you have valuations that are below historical averages. So valuations are attractive on an absolute basis when you take into account non-existent levels of inflation, low levels of interest rates. Stocks are cheap right now.
Now, you also say we're due for a technical correction here. What could be the catalyst for that?
Well, as we said at the beginning of the year, and we're saying right now in our quarterly outlook, investors should expect corrections and pullbacks and not be afraid from them. It would be perfectly normal. In fact, it's a bit abnormal that we've gone a full year now, 70% off of the March 09 lows, and we haven't had a correction of 10% or more. We got very close last February, but that was just about 8% pullback.
Yeah, false alarm there. Now, we were talking about the quarter end here. We're looking at a fourth straight quarter of gains for the major benchmarks. We'll see the second quarter start on Thursday. Could we see things change in the second quarter? Will fund flows continue to be as strong as they have been?
Well, we think we will, but I think we're just starting to see fund flows being directed toward equities. It is remarkable, and this gets to the psychology of the market. It is remarkable that even as the equities were 50, 60, 70% off of the lows, investors were still favoring bond funds over equity funds, and we think this is going to start to change. That is a reflection of investors' anxiety, and yes, still a little bit of fear. They're afraid they've missed most of the move, and they are afraid of getting whipsawed. So this backdrop is actually very favorable for the market.
So there could be a lot of potential money coming into equity funds. Let's talk about the top story of the day. The Treasury planning to dispose of its Citigroup stake, its 27% holding. You say that this is good news for shareholders. Would it entice you to buy the shares of the company? I know that you haven't owned Citi since, what, October of 2007?
No, that is correct, and Citi still is not an A-rated company, and so we're going to take a pass on that. And when I say shareholders, I wasn't specifically referring to Citigroup as opposed to, broadly speaking, equity owners. This is a part of the normalization of the financial markets. It's good to see the government getting out, and it's even better to see them getting out at a profit. And that is an undertold story that so far the government is making money on a lot of these rescue packages.
So how big of an overhang does this remove for the financials?
Well, it is part of that process. It is definitely the removal of an overhang. But financials as you pointed out a little bit earlier, they've come a long way over the past year, and they're still among the leading performers year to date this year. So a pause there would not be a surprise.
So how do you position yourself in this kind of market then? We have seen quite a strong run-up. You're saying that more money could still come into stocks, but we should be wary of a potential correction. What kind of sectors would we be looking at then?
Sure, Scarlet. We think one area that's been neglected is quality. This has been a lower quality, junkier rally off of the bottom. And as we look forward, we think the market is going to be shifting toward higher quality companies and shifting to more predictable, stable, steady eddies. Names like a McDonald's, like a Pepsi, like a Walmart that really have not participated as much as the broad market off of the bottom. We think there's tremendous value in those names, and those companies' earnings should hold up even if the economy's recovery and expansion is below average, as we expect it will be.
Okay, we thank you for your time. Hank Smith, the Chief Investment Officer of Haverford Investments, joining us from Philadelphia.